Hi everyone, and welcome to Beyond Tomorrow, a new series from the New Zealand Herald in partnership with MYOB, where we tackle the unprecedented business environment affecting thousands of small and medium-sized enterprises across New Zealand as the world battles to slow the spread of the novel coronavirus. I'm Will Trafford from Everyday. I'm joined by Ingrid Cronin-Knight, MYOB's country manager, and today we have Suze Reynolds, chair of the Angel Association. G'day, Suze.
Hi.
Hey, well, Ingrid, today we're talking raising capital, and I understand the latest MYOB Business Monitor survey reveals about 40% of business have never actually even tried to get into that uncharted territory.
Yeah, that's right. And I think the way most business owners think about things is that really around an organic growth rate of their business. And what I'm really excited today is, I know that inside the COVID environment, really what they're dealing with now is a working capital challenge around how they kind of finance through this cash flow crisis for some of them. But what we can talk about here is if you're wanting to do expand and growth capital, what are your options around that beyond the bank and financing? And also, you might want to diversify your portfolio and have a startup business in your portfolio, and what you might do to raise capital around that. It's really exciting to get into these details where it's not just the business loan guarantee scheme, which you can get access up to sort of $500,000 for businesses that have revenue between 250 up to 80 million. This is about looking at your business model, at your business plan, and what the growth agenda is, and then how can you potentially finance that to see your way through how you can drive a really profitable business off the back of it.
Yes, so well, maybe talk to us a little bit about why small and medium-sized enterprises might want to raise capital, and maybe from the VC sort of perspective.
Yeah, and it is a fairly rarefied environment, and and one of the things that even in the angel space, when we're looking at the kind of ventures that venture capitalists, and I put angel investors kind of in that category too, we often say do anything you can to avoid taking our money, because we're going to get right in your stuff. That's what venture capital does. So just to kind of expand on that, to make it clear, the kind of businesses that we're talking about, and startups is such a sort of pejorative term. We bandy it around and we all have a different vision of what a startup is in our heads. But the fundamental kind of criteria of a startup is that it's high growth. It has super high growth aspirations. And there's a kind of implication when you say startup that they will be looking for venture capital at some point, because if they're going to scale quickly, very hard to do that organically. And so implicit in that is the fact that those people who are providing that capital to you want that money back at a sort of 10x multiple at some point in the next sort of 5 to 10 years. So you can see why for the vast majority of SMEs, they'd just rather not go there. But that said, I've often wondered and often thought that there are some seriously cool businesses in New Zealand that, have the capacity to be globally competitive and to grow much faster and be making a much bigger impact than they are at the moment. So I'm really happy to be here to hunt that down with you both.
Hey Ingrid, I suppose there are some other options as well, right? I mean, it doesn't mean that you go straight to VCs. You've got potential bank options and contributions from directors themselves.
Look, I think that for many business owners, the first thing they're going to think about is how do they potentially and take their existing shareholders, which might be themselves and their partner, but take their existing shareholders and take out more investment, and how they can put that into the business to help it grow. And the benefit of that is it doesn't dilute the shareholding. There also are a number of organisations. If we think about working capital, many will go to their bank and ask for an overdraft, I'd love to see a little bit more access to a low interest overdraft scheme to help finance sort of just this current phase we're in, just to get through rents and things like that. But that would be to me sort of 10 to 20K just to get businesses going through this phase to move forward. Now, obviously, interest rates are a little bit more on that, and those are options. And the other one you then have is things like Pledge Me projects, or so they are looking to fund activities and a particular project, but without giving away an equity position. And so there are a number of organisations like Kickstarter or GoFundMe. Now, they are all international companies. I'd support our homegrown one here around Pledge Me projects, but those are options for you to get access to financing for a project that may help you in that more working capital kind of challenge or area that you might be navigating.
I wonder, Suze, if you can talk me through perhaps which businesses are most attractive, if you like, to VCs.
Yeah, great question. And I just add to Ingrid's point too. There are, Pledge Me also enables you to raise equity, and so does other crowdfunding platforms like Snowball. But back to your question in terms of what does an angel-backed venture look like? They will have, and you hear, again, sort of alert for the jargon here, a disruptive product or service. They're looking to kind of create new markets or make a huge dent on existing markets with a seriously cool product or service. They're looking as well at generally having some really neat piece of technology, not always IP protectable, but sometimes with trade secrets. And it spans everything from software as a service through to health tech, med tech, biotech, life sciences, clean tech, all of that kind of stuff. But as I mentioned at the beginning, one of the founding sort of tenets is they are going to need capital to grow fast. And they will also, one of the other kind of criteria is that super ambitious founder and team, someone with a bit of a chip on their shoulder who has something to prove, who has this kind of mission in life to make the world a better place with the idea that they have.
Presumably it doesn't have to be brand new companies either, right? Like presumably there are options as well for older companies who maybe been negatively affected by COVID, but they've got a really big sort of growth trajectory and a solid business.
Yeah, absolutely. But I come back to that kind of, it needs to be in your heart as the founder or the CEO. You have to be aware of just the level of kind of increased pressure that's going to be on you to deliver for those investors. And particularly in today's climate where raising that capital in the first place is going to require a special kind of tenacity and a special kind of business. But then if you've got an opportunity that's going to scale like a bugger and generate huge returns, then a hot deal is a hot deal. And in fact, as I've been saying, some of our most iconic companies globally and nationally came out of the last crisis, like Vend and Xero, LanzaTech, Uber, Airbnb, all of those companies were born out of the GFC.
Yeah, Ingrid, I guess the one thing that gets me is despite where you go, I mean, regardless of where you go, I should say, whether that be venture capital or anywhere else, you still need to bring those hard numbers, right? And prove that your business is a lasting one that can, repay that money, whether it be, if it's a loan or whether it be a repayment to shareholders through dividends, that kind of thing.
Yeah, the fundamentals don't change. I guess the level of ambition changes here, but also the access to resources. So when you look at your trajectory, if you've been sick before COVID, if your business was not in a good position, this is not for you at all. Like, this is around having kick-ass business model and a strong business plan and then a great team around it, like those three ingredients, and then looking at how they can scale. And just to give you some expectations around scale, I was talking to someone who had just gone through their second round of funding, and they were talking about needing to achieve triple, double growth. So that's they're a $1 million business. They need to be 3 and then 9 and then 18 and then 36 million over the 4-year projection. So now that's not the same for everyone, but that's just that particular business that in terms of scale and what they saw as they took their product and service they built here into the Australian region. So I think here, if it's not been a good run business, you don't have it. But if you've got a great idea, like I think there's going to be a whole heap of people that are thinking about contact tracing apps and how they can scale that across the world at the moment. But I think if you could bring something more than just that one idea, but to flesh it out around how you can really help the world either solve these new world problems that we're seeing in the market, then this is a really good opportunity. Or the other part is, and I see this as a weakness in the New Zealand market, and Susan, really interested in your view on this, is that over in Silicon Valley, they have a very clear view of funding stages, A, B, C, D, and then IPO. Here we sort of seem to go to the first round and then IPO. We don't have that kind of same level of rigor. Can you just sort of unpack the way, if you've got one of these high growth companies, what those funding stages would look like and what you'd have to consider at the different stages?
Absolutely, and you're absolutely right. It's not a straight line, and I think that's kind of it's a natural inclination in the space because it's so high risk and it's so seat of your pants and heart in your mouth, kind of, to torture both of those analogies to death, that you're constantly struggling for survival. You don't, you're growing so fast that you're always pushing the bounds of insolvency, because it's kind of been growth at all costs. I think we're going to see a bit of a reset on that front to be more about sort of genuinely value creating businesses that have revenue as well, that are sustainable. And I think, to your question about is New Zealand and how does New Zealand differ from Silicon Valley and other parts of the world, I think we've always been inherently more humble, and that's not always to our favour because we undersell ourselves, but we've always been very practical and pragmatic, and so we've been we're very efficient users of capital in New Zealand. So to a large extent, of course, we follow the kind of classic trajectory. You have your seed and your angel, and then your Series A. But we tend to raise less and do more with it in New Zealand, and so that can be blow our cover a bit when we go offshore, is because we will go, to Silicon Valley with a company, that's a sort of just getting off the ground, angel backed, first bits of revenue, that kind of stuff. And we'll value that company at about sort of 2 million. In the US, that's straight off the bat, that's 4 to 5 million. Who knows, what COVID's going to do to that in terms of resetting valuations, but I think that's going to be to our advantage as well, because we've been used to kind of running like that. That's how we roll in New Zealand.
I wonder, Suze, if possible, you can sort of talk me through, if you decide that maybe you've got a new business model, you're going to pivot a business and you think you've got a potential really big growth opportunity, given how the market is going to change with COVID, how do you approach a VC? Is it a deck like a startup would do? And what sort of information do you bring along with you if you want to be really successful?
Yeah, that's a great question. And as a really lovely colleague of mine often says, people do business with people. And so that's the first thing, be warming up, building those relations. Kind of tricky in COVID when we're not going to kind of, events and that kind of stuff. But actually, in some ways, easier, make the cold call, reach out to a VC or an angel, and just say, look, can I have 20 minutes with you on a Zoom call? I just want to talk to you about my opportunities, sound you out, see if it's even a flyer. But yes, you refer to the classic pitch deck. They're typically no more than sort of a dozen slides, preferably more like 8. And they've got all the, team, opportunity, competition, business model, financials, what the deal is, size of the market, all of those things. And you Google pitch deck and you'll get 60 gazillion different versions of that. But pretty much it's keep it pithy, keep it tight, and keep it real, and keep it authentic. I think that's the big thing at the moment. Be authentic. And I often say it's one of the most liberating things about this space is that you are not doing yourself or anyone else any favors if you try and sort of play up to what you think the classic founder or entrepreneur looks like. Be yourself. Otherwise, you're not going to make the right kind of connection, and you're going to run aground, sort of 6 or 8 months into the relationship, because you can't keep faking it.
Yeah, I had a VC that I worked with once that was obsessed with dressing like Steve Jobs. Sorry, a startup founder who's obsessed with dressing like Steve Jobs. So he had the turtleneck and he had the sweater on the whole time. And I tried to explain to him that what the VCs were looking for was creativity and originality. The last thing they wanted to see is a knockoff Steve Jobs. They wanted to see the new, innovative next guy. Yeah,
exactly. And that's why, if you're an introvert, that's absolutely fine. You can still make entrees. Introverts kind of tend to struggle a little in the raising capital kind of space because you do have to be able to stand up and talk to a crowd. But in actual fact, COVID's your friend. You don't have to stand up in front of a crowd so much anymore. This kind of forum is way less threatening, far more accessible. Get amongst it. If you think you've got something huge value, and there are ways around that too. If you don't like standing up in front of loads of people, then you can find a co-founder that can do that kind of stuff.
Ingrid, I guess there's different VCs for different businesses as well, right? Depending on sort of what you might be targeting, specialised VCs around tech or consumer goods, any that kind of stuff.
Yeah, I think depending on where you want to go, and I think it's you can either start at your local chamber of commerce to see if there are any investors. It's not traditionally a VC kind of firm, but they might be a range of investors. I know that Craig's Investment runs a secondary market for private equity, and so there's a way through there that you may be able to get access to information. But usually the accelerator hubs are linked with a venture capital fund of some sort. You've got Callaghan Innovation, who's looking for government tech investment. You've also got Icehouse. There's a range of them across the country. I've only listed a few. I'm sure, Susie, you know more than me, and you could add to that whole list, which would be great if you could.
Yeah.
But ultimately, this is around getting down to the fundamentals. And what is great is not just the money, but usually they want to protect their investment, right? So they're usually going to give you someone that's going to have a seat in the board to help work with management. And they may look to give you additional resources to help complement your growth, or they're plugged into the network of specialist people in the domains that you play, and they can connect you into mentors or other areas where you potentially don't have that kind of expertise yourself.
Yeah, that's a absolutely bang on point. And we often talk about smart money, finding smart money, and definitely that's kind of one of the things that you should be looking out for. But you won't always find smart money. It's not, and particularly if you're experienced enough and you know your business well enough. But nobody does this alone either. So definitely looking out for that investor who at the very least is aligned and who gets you, and who one and one is going to make sort of five by buddying up with them and having their investment. I think that's really critical. And having a bit of a bead on, what kind of networks and experience they're going to bring is critical, particularly offshore. That's getting entrees and warm introductions to people who are going to grow market channels for you in offshore markets is really, don't underestimate the power of that. Cold calling and, sort of wearing out shoe leather to, close deals, hard yards.
We had a panelist the other day who made a recommendation that when you are going offshore, really target the Commonwealth countries, because they are more aligned culturally with our value set, and that lines up better with business owners and their ambition. What's your thoughts on that? That all makes kind of instinctive sense. That said, one of the things that I have got the hugest buzz from in the last 2 or 3 years in the New Zealand angel space has been being on the wing of Zeno Ventures, Chinese migrant investor network. And they are incredibly aligned with Kiwi values in terms of, and particularly Maori values in terms of intergenerational wealth, being in it for the long term, all of that, how important relationships are. If you were looking for kind of Chinese capital, getting alongside the Zeno Ventures guys, really good guys, lots of giggles together, shared aspiration, very smart. And so for me, that's the key. And I think that's implicit in that Commonwealth comment. You get them, they get you. That's really what you're looking for. It's not so much whether or not they're Commonwealth or other. It's just, do they get you? Do they understand you? Have you got someone who can translate? I would hate people to kind of limit their ambition or limit the opportunity by thinking that some of those other markets are kind of off limits or just too hard.
Yes, Susie, would you sort of encourage going further afield, perhaps, if there wasn't local appetite for your idea? I used to work in the UK, and it wasn't really sort of uncommon at all for UK startups or early stage companies to head over to San Francisco to raise ground funding and that kind of stuff, because I guess market dynamics were slightly different there, and maybe the American market was willing to take more of a gamble, I suppose, on small companies.
You've still got the relationship thing, which, again, I wouldn't let the fact that you can't jump on a plane at the moment be a handbrake to exploring those, but it's going to require sort of a little bit more creativity and tenacity to build those relationships to get that kind of investment at the moment. But do your research, suss out, and that's what I say even domestically, suss out which angel network, which angel is the best fit for you, both from a kind of vertical perspective, but also just personalities. Don't undersell that. The ability to get along and start conversations with each other, get cross with each other, have a laugh together. All of that stuff, and when you're growing a company fast, super important, because there's going to be tears as well as the high fives.
And then look beyond that. I think if you think about VC as being like the Uber growth trajectory, and then organic growth being the middle of the ground, what I've seen other organisations do is really, sort of the more moderate trajectory. And sometimes they might get the help of an organization like there's one called Disrupt, who help with your marketing strategy and how you target new markets. But really what they focus on is around the ability to do a deal. So once you've really got clarity and you've pivoted your business, and there's another episode that you can have a look at that, but once you've kind of thought about that and where you can play, it's really around the elegance of doing the deal. And sometimes with some of those deals, you might end up getting a equity stakeholder, but they might end up, by doing that deal, they might get a seat on the board, but they also might finance your operations and give you some certainty for a period of time. Yeah. So it might not be as extreme as sort of an angel or VC where you trade off a lot of your equity for the high growth. It's in that more moderate growth and that more moderate kind of trading scheme, and that I think is an option for some other businesses that don't want to go on the high growth journey.
My question, Susie, was what's the magic number? How do you know how much of your business to give away, and for how much are your ratios, or how do you decide?
One is having a really clear sense of what your business is worth. And another really important piece to be aware of is understanding how and where you want to get out. And that's around the sort of liquidity piece, the exit piece. So if you give away too much in an early deal, by the time you get to that exit point, and it's not uncommon. In fact, I've invested in a company where the founder was at 4% when it was time to kind of leave. And that's just less than ideal. So those kinds of things are really important. I think the big thing with to be able to answer that question, it's so context dependent, is to answer that question, how wealthy do I want to be when I get out of this, and what time frame, 5 years, 10 years, and then work backwards. And what does that mean for how much equity you need to have now, and the capital strategy? What amount of funding are you going to need after this deal, after this capital injection? Are you going to need more or less? In the angel space, we're always highly skeptical of anybody who says this is the only capital that I'm going to need to raise.
And in that first angel round, is it a prerequisite that you give away over 50%?
No, ideally, you give away as little as you can at a valuation that is as high as it can be, that doesn't ankle tap you when it comes to raising that next round. Because when you raise the next round, your valuation is going to have to be at least double, if not triple, depending on how much equity you've given away and how much equity you want to raise at that next round. Ideally you look to keep as much equity as you can. You want to aim, in a classic kind of angel scenario, you want to have at least 30% equity when it comes to that liquidity point, at least. Don't give away too much. And that's why you quite often see in early angel deals convertible notes, where they're sort of kicking that discussion down the road a bit, not having to have the valuation discussion too early.
Off the top of your head, 2 or 3 tips for a small or medium-sized enterprise leader who is looking at the COVID situation at the moment, who might be really struggling. How do we think perhaps a little bit more innovatively or a little bit differently, to steal the Steve Jobs sort of notion, if you want, about your business, or about making your business more attractive for either raising some money or even potentially, selling it if you have to?
Be true to yourself, hang tough, keep the faith, and nurture relationships. Those 2 things, if you have those 2 things, then that in itself, I think that will give you an advantage. And the innovation piece is, I think, step up and don't be afraid to be talking as much about impact and value and that kind of stuff as you are about growth and returns and that kind of, I think that's probably one of the big things I would suggest might be a plan.
I think, Susie, it's been fantastic to give this kind of insight around how the money flows through the investor community and what you might need to tap into that if it's appropriate. I think you said right at the outset, the best advice is not to come and see us if you can. And so we did mention that if you can get someone to pay for your idea, then and you can finance it via cash flow in terms of your growth, then that's always the best thing, because you as a equity owner get to maintain control and And that would always be a great place to be. But if you can't, and you think, though, that to scale your idea and have the impact on the world, you want to go and really grow your business, then I think we've gotten some great insight today from you around who they can go and talk to that aligns with their values and where they're wanting to take their business. And so I think it's been a fabulous episode for us to do.
Thanks, Ingrid. It's been really fun to talk to you both. Thank you so much.
Ingrid Cronin and I couldn't have put it better myself. Thanks very much. And Susie Reynolds, the chair at Angel Association, thank you both so much for all the really helpful advice. Remember, we want your questions as well. Email those through to video@nzherald.co.nz. Until next time, I'm Will Trafford. Thank you so much for watching. Bye for now.